Don Luskin, what does this mean exactly? Yep. The dollar had its best day against the euro since 2004, according to some circles. Gold continues to tank. Oil is beginning to follow gold, and stocks seem to love it, Don. Can you make sense of this big picture and a little changing scenario?
Yeah, this is easy, Larry. It all goes back to March 17th, Bear Stearns Monday. That's when the world changed. That's when the Fed figured out that it can solve the credit crisis by something other than cutting the funds rate. And so ever since then, all of these different markets that you've mentioned have gradually come more and more to realize that it's one and done at this point at the most, and that the Fed is going to start hiking again as soon as October. The futures markets are now looking at 3 rate hikes from out a year from now. So that strengthens the dollar, it weakens gold, it weakens oil. It's great for stocks because it means that the Fed is going to stop fueling the inflation machine and that there's confidence that the credit crisis has been mastered. This is just fantastic news. And by the way, you didn't need to read about this in Greg Ip's column in the Wall Street Journal today. All you had to do is listen to this show for the last 5 weeks.
Yes, you're very kind, and I appreciate that. No, Don, another interesting thing is we may have seen a pickup in the factory sector in the month of March because outside of the auto industry, which is cutting back like crazy,
right.
Ford profits, by the way, up because of the cutbacks. However, durable goods orders up outside of automobiles by 1.5%. We even saw some decent news on CapEx shipments in the month of March. Is it possible that that whole factory CapEx business investment is bottomed out in the late winter?
I think it is. In fact, I think that by and large, most of the macroeconomic data flow that we've been getting over the last month has either been downright good or at least surprising on the upside, but certainly has not been at recessionary levels except for the rare outlier. So I think what the Fed is going to have to start doing here is saying, whoa, we really front-loaded this, and the data has to keep getting really palpably worse for us to cut rates a lot more, because for goodness gracious, they're already 2.25%. Other than that 1% crazy low benchmark that Bernanke and Greenspan set in 2003 and 2004, 2.25 is already a rock-bottom interest rate, and there really is no further deterioration showing in the economy. There is improvement showing. The idea that given all the inflation worries that they've got, that they're going to cut rates again from here, I think, frankly, is absurd.
I think what's kind of silly, I sit here and I start chuckling because you guys are saying rates are going to go up, and that's going to be, now tell me how that's going to be great for housing. That's what I want to know, especially when all of those pay option arms that were done back in 07, early 07, and even before that, start recasting as the rates start rising a year from now. You're telling me that's going to be good for the economy?
I'm telling you,
Herb, has cutting rates like crazy been good for housing?
It hasn't. So my point is,
so it doesn't matter. So it doesn't matter. Housing is just a planet in its own orbit. It's going to have to take care of itself. You cannot solve that problem with rates. And if you try to, you've got a big inflation problem.
Don Luskin, the McCain surge starts in late January. That was the first bottom in the stock market.
Right.
The second bottom in the stock market was in early or middle March after the Bear Stearns JP Morgan deal and the Fed opened up the discount window. Is there a correlation between politics and the market?
Yeah, I think there is in the long term, but I think there's a lot of noise right now that's making that correlation very, very hard to really pinpoint. We really do have a serious credit crisis, which as late as mid-March did pose systemic risk to the world capital markets. And, Ronald Reagan could come back from the dead and announce that he's going to be the next president, and if the Fed hadn't done what it did to bail out Bear Stearns, there was going to be a global depression. So, yeah, politics are important, but they've been in the back seat. But the interesting thing is, now that's going to come into more focus, because as the credit crisis now steps back, what's going to come center stage is the political scene. And I have to say, I'm not thrilled about that. Because
one thing, though,
McCain has yet to articulate a clear, compelling economic message, and the Democratic economic message is just a suicide pact. So this is going to be dicey.
Larry, the one thing I want to add just to what Don was saying on the credit crisis, and it ties in, I think, what Herb was saying earlier, and why financials are rallying. I think that's a very good question. Why are they rallying? Because the financing rates with which financial institutions are based, LIBOR, is significantly higher than it was before. And one of the things these low rates that most people on the show here have poo-pooed is that they have reduced They
How
did
much
reduce
higher, Joe?
financing costs
Seriously,
for
Joe,
institutions.
How much higher, though? I think this LIBOR thing is overrated. How much higher? We're talking
let
about
me
what,
this
20,
way.
20
LIBOR
25
was
basis points?
No, much more than that. There was 7 basis points over Fed funds last summer. It's going to possibly be 100 over. That's a huge problem.
But we can't find that 100 over. I mean, we've got
the spread doesn't matter. It's the absolute levels. The absolute levels are far lower today than they were.
That's incorrect. That's not true. The spread and the level both matter.
Joe, isn't it? Look, you may be right.
Not to what you were talking about.
No, the spread reflects the fact that people aren't lending. Well, no, on the mortgage rate, Don, it does matter in terms of resets being set to LIBOR. LIBOR is still a very important benchmark
but mortgages don't reset to the spread. They reset to the absolute level.
Right, but the absolute level, Don, is higher. LIBOR is 290.
Yeah, but it's only
higher than
I know, but it was
higher. It's not high. It's not what you said. It's not higher than it was last summer.
Yeah, it was 6% last summer.
It is.
It was 6% last summer.
And it came down because the Fed cut. That's what I'm saying. These low rates have helped. But the point is there's still incredible stress in the money markets, and I think the market has completely forgotten that.
All right, we're going to go out. We got so much more work to do.
It's forgotten because it's not important anymore.
But if you look at China, look at the news out of there, a 9% move in the Chinese stock market, and largely because a barrier to domestic investment was removed.
Walk us through
this. That's all cap gains is. It should be gone altogether.
Jack, take a step back for our viewers who may not follow this. This was great. Big news this morning. We all picked up on it. The Shanghai stock market up big. Now, what tax did the Chinese cut?
Right. It's a tax. It's a barrier to domestic investment. How much folks can invest?
To transactions tax.
Right.
Excuse me, I need to interject. What the Chinese did is they lowered the stamp tax, the transaction duty on already existing public share transactions. That was something they put in place 6 months ago in order to cool off their stock market. Their stock market fell 50% after that, so they've simply gone back to where it was 6 months ago, saying, mission accomplished, fine, we no longer need to quell speculation. So look, I'm as much as for anyone else on this show for tax cuts, but let's tell this story straight. All they did was set a transaction tax, a stamp duty, back to where it was 6 months ago.
It's a lever to pull.